Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard.
All right, Guy, don't be coughing over here. I need a screen between us.
There is no chance in the world that we're going to get through all 5 segments of this show without our audience hearing me cough, blow my nose, or something.
See, the flu bug is gone through the Metroplex, if you haven't noticed, and Guy caught it.
Victor,
gave it to his wife.
Yeah, that's right. Victor and I went to Atlanta last week for some coaching on administrative stuff and building a team and all that good business owner stuff. And somehow between Atlanta and getting home, I caught this dang thing. We got in about 6 p.m. Friday night. Went to bed about 8 because I was already getting kind of tired and run down. And about 2:30 a.m., boy, I popped up out of bed. Throat was raw. Couldn't breathe. And those double-barreled nostrils were stuffed. And ended up going to Care Now, and Mr. Allard, you have the flu.
I was worried because that stuff takes a little while to incubate, so I'm like, you were probably contagious right next to me for the whole plane ride.
So don't blame Atlanta?
No,
I
sure it has to do with Atlanta.
I had that before going, so then I'll blame Stephania at the office because she was the last person I knew that had it.
I know, we need to quarantine everybody, I think.
And, of course, this was Saturday, right? So start the Tamiflu Saturday about noonish or 1ish after getting out of Care Now. My wife, Chris, gets deathly sick, Tuesday, and she's mad at me. And I said, sweetheart, it's a community state. You always tell me half. That's your half. No, is that wrong?
That's right. Well,
anyway.
What's the... just to let you know, by the way, for people that never heard the show before, for, 25 years, we've been producing this show to answer your financial questions. And we like doing it a little differently than a lot of other shows out there. Most of your shows are basically an hour-long infomercial on how to come to my seminar. Come to my seminar. Don't get me wrong. We want people to come to our office. We manage assets, and we have for 30-something years each. But we try to also teach you something you can use. If you're too young, you don't have enough assets. If you're, you love your financial advisor's your brother, whatever. But these are still things you can use.
No. If your financial advisor's your brother, you're good where you are. Right. No?
Right. That's what I had. Somebody goes, I really like you, but it was a brother-in-law.
Right.
As I said, well, I don't know. I don't know what your family dynamic is. If they're doing a decent job, I'd probably just stay where you're at. If they're not, well, then
I've had people that have had relatives like in-laws that manage their money, and we're doing a terrible job, and the fees were high, and we could take a look at things, and we kind of exposed all that prior to knowing that the relationship was there, and there was no way in the world. They were scared. You've told me about clients. They were scared to call the advisor and tell them that they were going to move the money. And jokingly, I would tell them, well, if you want to send them a check for $5,000 a year, go ahead, but move your funds so you can do better. No?
Right. And there must not be like my family. I'm pretty sure I would not let any family member I have know, besides my immediate family, of course. But what I have, or, let them manage it.
You can't be a prophet in your own land.
That's right. So maybe they have a different family dynamic than I am, and they are a prophet in their own land. It's like,
that's true.
I don't matter how many accolades you could get, how many trophies I've got, all this different plaques and everything else to your wife, that doesn't matter. They're like, whatever.
Now when you're not around, unbeknownst to you, they brag on you and they're telling you, hey, my husband has this and he's done that and he's got a radio show. But when you're around, oh no.
My dad did
no
that
recognition.
Forever. My dad always, because I started out working with him when I was, 23, 24, just for a couple of years. But his old saying was always, boy, I taught you everything you know, not everything I know.
That's a good one.
And I never got, even when he died, I never got a compliment out of him. Man, I love him, of course. But every other relative said, oh, that's all he does is talk about you.
Yeah.
How proud he is of you.
Yep.
I was like, what, did it kill him to mention it once?
Apparently. Apparently so.
It's weird how it doesn't matter what your parents are with this, but you want affirmation from them, right?
Have you gone out of your way to tell your kids to make up for that?
Oh, hell no. I'm doing the same thing.
Oh, okay. I was just wondering.
No, I'm kidding. I do tell my kids.
I know
a little different. I'm a softer, gentler kind of generation, I think. Like I said, my dad told me he loved me right before he died, and I was in my 50s. So it was just, but obviously he loved me a lot. He was a great dad. But it just, at that time where he grew up, men didn't say that kind of stuff. They grew up working hard in the cotton fields in Greenville, Texas. And so they tell me the stories about them going and getting RC Cola, because RC Cola came in like a 16-ounce bottle instead of like a 10-ounce bottle or whatever, and a peanut patty. And that's what they do at the Woody's in Greenville every week.
Now, I'm not that old, but do you remember?
Yeah, you are.
No, I'm not. Stop that. Do you remember what was under the bottle caps of RC Colas for a while?
No, I don't.
You could win money. No prize, 10 cents, a quarter. If you got $1 or something, it was a big deal. But yeah, every bottle, you had that potential to win a little bit of money.
Right.
And it said right on the underneath on the plastic liner of the bottle cap.
Oh, yeah. I remember all. I remember.
Of course, the bottle was worth a nickel.
No, we used to get a quarter allowance every week, and we could go down to the Doherty's Drugs. Is anybody guys familiar with Preston Hollow? It was right at Preston and Royal.
Was this during World War II?
Yeah.
Okay, just checking.
We go buy a Coke and a candy bar, and my kids, I'll tell that story, and boy, they think you're like old as Methuselah. Oh my gosh, a quarter for a Coke, and I go, yeah, and walk down there.
Aren't you one of the last living World War II vets?
Could be. That's what they think.
No, I know.
I had my kids talking to somebody, said, no, you don't understand. My dad's really old. I mean, really old. I was like, but I don't know what happened. I've been on these think tank deals. We help design, different products and everything. They'll take, some of the biggest producers and advisors in the country, kind of put their heads together to design different products to solve different retirement needs and, give different solutions to retirees and pre-retirees. And I've been doing that for a lot of years. And it's always funny how when I used to go to those things, I was a young buck, the young guy. Hey, that's a young kid. Yeah, I'm not the young kid anymore. Now there's a whole bunch. I knew I was getting old when NFL football coaches were younger than me.
Oh, they're getting young now.
Way young, right? Because remember when you were a kid? Oh, those guys are like 80 years old probably.
I remember being 23 waiting tables, and the captain of the team was 25, and I thought he was an old man. Oh, yeah. No. It's perspective. Our perspective has changed.
We're in the Navy, and we call them lifers, people that want to stay in the military forever.
Yeah.
Nothing wrong with them. We just thought they were old, crusty. The oldest one was probably 35.
Yeah, and you were 18 or 19.
Yeah, I was really young. Oh, they're grandpas.
Oh, yeah. Starting to put a little weight
I
on
see a little bit of gray in their hair. I'm
right.
like, holy crap, the guy's older than my dad. A couple of the chiefs were, they're only like 32 years old, but they seem so old when you're
Did
18.
you max out your retirement accounts when you were 18 years old?
No.
Exactly. If you can do that out there, listeners, you'll have the world by the...
That's why people always say to me, what's the secret to saving a lot of money? Making it deliberate, making it early, doing it like right out of your paycheck so you never see it. Like if you get a raise every year, maybe put that raise, add that raise to a 401k contribution.
It's got to be a priority. It's got to be something that you enjoy. You've got to be disciplined. I've got a cousin in Chicago who's very wealthy, and he used to play games with himself. I mean, this is how myopic some of these guys can be. For every mile that he put on his car, he had to save $1.
Wow.
So, yeah, if he drove 100 miles this week, he had to put $100 in a savings account.
That's actually a pretty good idea.
He put 15,000 miles on his car this year. That year, he had to save $15,000. Well, he's the type of guy, and it's that mentality. It's hard to teach, right? Either you have it or you don't. He's one of these cash guys. He's got a big building that he's a manufacturer and machinery and, several shifts. But everything, the machinery, the building, the car, cash.
Well, he's a good example.
And his only investment, what do you think it was? The only place he'd put his money.
Real estate.
CDs.
Really?
Oh, yeah.
No one take a risk. The people, it's weird. You might think a physician that makes $500,000-$600,000 a year has more money saved when they retire. A lot of time it's an engineer that makes $100,000-$200,000 a year that just has always methodically saved.
That's right.
Because how many engineers, like I said, that's probably our biggest client base, engineers and doctors. But how many engineers have you seen that don't max out a 401k?
None. Well,
I've seen maybe a couple.
I don't know.
Over 30 years, couple. And that is the first step you should always do, right? but they're the ones that they saw that benefit really early, and they stuck with it. I've got them starting at 22 years old, right out of college, 24, whenever they get, and it's right there. Yep. They're saving. My oldest son is kind of like that. He was saving when he was working part-time. He always saved money. Now, he doesn't believe in money, so it's kind of weird he saves it.
Right.
I said, well, if you believe that so much, why don't you donate it all to charity? All right, what we're going to do, today's show is going to be about your questions, all about your questions. These are questions that have come in from phone calls from our radio show, clients, prospective clients in our office, and people that give us a call this week. The last 2 weeks, we're trying to compile some of the questions. If I think they're going to appeal to a broad audience, we're going to share them with you, and we'll do that right after the break. Don't hesitate to call us if you have any questions, 972-715-2424. Again, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, right before the break, we said this show is going to be based on the questions you received. We received over the last couple of weeks. Some of them I'll kind of embellish when they go, but anytime I think they're going to appeal to a broad audience, I'm going to share them with you. And because some of these things, I keep getting similar questions. Besides the normal, what's the market going to do? I take my Swami's hat off and I say, I'm not really sure.
Right.
If I knew what the market was going to do, I would have, one of my many yachts in Tahiti. I'd probably be in Tahiti right now, just for the heck of it, right?
That's right.
Making billions on a phone call, stuff like that. Nobody knows where the market's going to go. Nobody knows where interest rates are going to go. I can make an educated guess that the market's going to be volatile and should have a correction since it's gone up almost 10 years in a row. I can make an educated guess since the Fed's policy has been raising interest rates, more than likely they'll raise interest rates, right?
Right.
But it could go just the opposite. And so you just have to be prepared for anything that happens. Especially a retirement plan. A retirement plan is something that you have to have bulletproof. Whether that's, you got to make it idiot proof too. And whether you're an idiot, the person holding the account, or the advisor, you got to make it idiot proof either way.
And right now, with politics being the way they are, depending on who gets in office, you don't know if your economy is going to be market driven or government directed, meaning capitalistic or socialistic. You've got both sides pulling. Hopefully we know which way it'll go, but all of those things, tax laws change. There's a lot to stay on top of. Are you ready for a question?
I'm ready.
All right, let's see if we can knock these out. First question is an oldie but goodie. We seem to get this fairly often, but it's probably time to go through it again. I went to a Ken Fisher seminar, and he didn't have many good things to say about annuities. Is he wrong, or are you wrong?
The first thing I'd say about that is you can't blanket an asset class or a type of investment. In other words, just say bonds are the worst thing in the world. Well, bonds aren't the worst thing in the world. Neither are annuities, neither are stocks.
He says the same thing about mutual funds and points out their mistakes.
And mutual funds are not the horrible thing. Now, I think once you develop enough cash, then you can go beyond mutual funds. But for someone starting out, there's nothing wrong with mutual funds. There is nothing wrong with mutual funds. So you got to know that going in. And it's extremely difficult in this business to get unbiased advice unless somebody is licensed, qualified, and more importantly, compensated on all the areas of finance. Let me give you an example. Let's say a person only does stocks. Well, annuities are the devil's work, right? Even if they were licensed but they don't get compensated for it, do you think the advice is going to lean towards the stock side? And vice versa. If a person just has an insurance license or just likes annuities, thinks the stock market's a casino, do you think they're going to recommend stocks to you? Or do you think they're going to say it's a Wall Street casino? Why would you throw your money in there? The Wall Street's crooked, right?
That's right.
So they'll go either way. So it's like asking the Ford dealer, should I go buy a Chevy? Well, of course you should. Let me give you a ride down there, right? Nobody does that. So you got to be careful. They're selling one thing. It's one of the greatest marketing ideas I've ever seen because it's doubled his assets under management the first 2 years that he started that I hate annuities or whatever. But the one thing you have to understand is there's there's two parts of your investing lifestyle, like the cycle, right? First is the accumulation phase, and then there's the distribution phase. And the stock market has been pretty good at the accumulation phase. The problem is once you distribute assets, it changes things. We've talked about this before on the show, the sequence of returns risk. Now, I have a new calculator that illustrates this issue or the problem that if you stay in the accumulation phase, in other words, let's say I've been with an advisor for 30 years, and they've done pretty good. I'm pretty happy with the thing. If you stay in that same or similar allocation when you retire, things can go bad quickly. What I could do is I can take, say, 10 or 12 years of the market, have up years and down years in there, right? And I'll show you, no matter how you mix up the years, if you're in the accumulation phase, your return will be exactly to the penny. In other words, if you load all the negatives up front, or all the negatives in the back, or the negatives in the middle, it doesn't matter the sequence of those returns, your ending value will be 100% the same every single time. You can hit this button that randomizes the returns 500 times. And the number will always be the same.
If you have the time, it's worth it to you. If you can swing by the office, we'd be happy to show you. It will blow your mind when you see how the spreadsheet works.
So what it does also is, since the return is exactly the same always, no matter what, it kind of proves the buy and hold theory. It proves it. In other words, as long as you stay invested and stay in the market, you will get these returns regardless of the order of the returns. So it proves the buy and hold theory. Here's the rub. When you start withdrawing money, let's say you're going to take out 4% a year, 5% a year, whatever your number is, it changes drastically. That's what the secret is. In other words, if you take losses early in the retirement, you go broke. Or it exponentially raises your possibility of going broke. If it's at the end of retirement, it doesn't affect it as much. And so we have designed a calculator that will show, okay, what if you did a low-cost annuity in there instead? Like, let's say you put 25%. So 75% in the stock market, 25% there. And you'll see the value, when you randomize it, is always higher with the annuity component, just 25%. Then we also have one that shows 50%. It's always higher because of the mathematics of a down year. In other words, when the market loses 50%, it has to gain 100% to break even. So you not only have to make up that 100% plus your withdrawal that you've made, right? So this will show you that no matter what, anybody that tells you should be, albeit stocks or managed program when you retire, is not looking at the math. We'll talk more about that after the break, but don't hesitate to call us if you have any financial questions. 972-715-2424. Again, 972-715-2424. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back. Welcome back to the show.
Welcome back to the Common Sense Investing Show. I'm Guy Allard. Victor McClure and I are answering your questions today. The first question we covered was from a fellow that went to a Ken Fisher seminar, and apparently Ken didn't have many good things to say about annuities. Victor went through quite a bit of that in the first segment. I'd like to tag on a little bit if I can. If you keep in mind, annuities, everyone fights for your investment dollars, right? So annuities and stock guys, the annuities and the stocks are constantly fighting for your investment dollars. Either one of them would probably like to have all of your money with them. And we know that that's not the proper place. Another reason, and Ken talks about it, that you want to have a fiduciary manage your money for you. Now, you would think when someone's managing your money, they would automatically have your interest first, right? Which is what fiduciary means. But you want a true fiduciary. Also keep in mind, when you see these ads, and we'll talk about Ken since that was our first question, Ken pays millions of dollars to stay in front of you, to raise these questions, to be provocative, to get you to think, to get you to call and question if you should do anything else other than invest with Ken. So when you hear these things, like we try to do, and we're trying to do some due diligence to find out if we want to invest in something or buy something or whatever the case may be, you've got to look for objective points of view, not subjective points of view. Now, the problem with that is an objective point of view from a Yale professor. I can think of a couple PhDs. I can think of some Nobel Prize economic winners of the Nobel Prize that have 10-page white paper on what you should do and how annuities for a portion is good. And yes, how managed money is good for a portion. But they're not paying millions of dollars every month to keep that in front of you so that you're well informed and you've got an objective point of view instead of a subjective point of view. So keep advertisement where it is as an advertisement. It may be a muse. It may get you starting on your quest for the right things to do, but it absolutely isn't the gospel.
Well, that's why you got, for every person that says you shouldn't do annuities or every person that says you shouldn't do stocks, I'll give you a Nobel Prize winning economist that says otherwise.
What do you say about
So somebody that doesn't have any skin in the game whatsoever, they don't care what you buy or what
right.
you, right? And we'll get that every single time. It took a long time because you remember when we first started doing index annuities, low cost, zero cost to 1% tops. The Merrill Lynches of the world and all the different ones said, that's a terrible. Every single one of them.
I'd rather burn in hell than sell an annuity.
Right. Every single one of them does them.
Now,
every company
but
that
they're
said
limited.
we only do variable annuities, which are high cost crap, now does index annuities.
Right.
Just about every one. It's 80-90%. So for all those people that said it wasn't legitimate, they're pretty much all doing it now. Of course it was legitimate. All investments they have their place. They're not good for everybody. No investment is good for everybody. But there's nothing wrong with stocks. There's nothing wrong with annuities. I do have an issue, though, with high-cost annuities or high-cost managed stocks. I got people that put mutual fund together, put a wrap on it, and so they're charging 2.5% on a mutual fund portfolio or 3% on a managed account because they're putting it in retail mutual funds and charging 1.5% of an RIA fee. So there is a difference there. There's some truth in anybody that says you shouldn't be in stocks, you shouldn't be in mutual funds, you shouldn't be in annuities. But when you put the whole picture together, it's just a sales pitch. They're selling you something else.
That's right. And when you're looking at this stuff, whoever you're working with, and we'd love for you to call us. We each have 30 years of experience. We've never, either one of us, had a customer complaint. But what they should do for you is they should put all of this in some sort of spreadsheet or program and let you play with it. You put more annuities, less annuities, more stocks, less stocks, bonds, rising interest rate, don't want that. And play with it and see numbers, as you always hear us say, don't lie. It's black and white.
Right. We'll show you before we make a recommendation. If doing only stocks, we'll show you, okay, here's what happens if you do only stocks in your stress test. Here's if you add a 25% component to this or a 10% component.
That's right.
So you'll see real time what it does to your particular portfolio, not just giving some sales pitch for or against anything. Just saying, here's what the numbers do when you plug this in. All right? And that's what we show you instead of trying to just sell you an annuity or trying to sell you our managed program.
That, and I'm telling you, I can't tell you, I'm excited. I can't tell you enough how much the sequence of return calculator will blow your mind when you see the difference when you hit the random button 5 or 6 times, what happens to the outcome, and then when you diversify your portfolio out of that, when you're in the distribution phase, and that's the key. If you'd like to come in, if you'd like to see that, if you'd like to go through the retirement analyzer, it's much easier to do. It's not a big deal, 3 or 4 questions. Our phone number is 972-715-2424. Sarah is our assistant, and she'll set you up with the time to come in.
Yeah, just remember, just try to keep everything in an objective point of view. What do I like? You're going to have your own biases. Everybody does. But use it with science, and that's why I tell you, for every person that says this, I've got a Nobel Prize winner economist that says otherwise. But stay with us, folks. We're going to go through more of your questions when we return from the break. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
Welcome back to the show. I almost fell asleep for a second. I forgot. The light was on.
Nobody was home.
All right. Today's show, we're talking about your questions. We spent a little longer time on that one question because we get it so often. But what's our next question, guy?
Next question is, why should I put money into my 401k when my outside investments, like real estate, are doing so much better?
Well, the main reason is the mathematics of a tax-deductible, tax-deferred contribution is virtually impossible to duplicate, especially if you have a match if you run the numbers, like I said, if let's say I want to put $1,000 after tax, I'm in the 30% tax bracket. That means I can put $700, right, into an outside investment. So already it's got to be 30-something% more because I can put the full 1,000 into the 401k. So it's got to be 30-something% more. Plus, on this outside investment, I'm probably paying taxes per year, right? On any, like if it's a CD, or you got interest payments. If it's long-term capital gains, there's possible taxation there. And your 401k doesn't have that until you actually retire and distribute the assets. So if you ever run the numbers, it is extremely difficult. There's nothing wrong with real estate. I own rental properties. I own a house, and other house. So there's nothing wrong with real estate at all. But they're different. They're different investments. I don't care if your 401k is making 5% and your in real estate is making 10%. Mathematically, you're still better off putting that money in. You got dollar cost averaging. You got match. There's all kinds of reasons.
You can always max the real estate. Yeah, one of the things the 401k forces you into dollar cost averaging, and the sooner you get started. If you, let's say you make 7%, that's maybe a high number, but in 10 years, your money doubles. What happens in 20? Now it's quadrupled. What happens in 30 years? Now it's gone up 8 times. If you're in it for 40 years, put you at 60. If you started at 20, it's gone up 16 times. And if you're in there till 70, 10 more times, your money has gone up 32 times, your early money. And the rest, the 16s and the 8s and the quads are still there. You can't beat that. So we always talk about that's other than having your emergency bucket, your cash that you need, which should be 6 months, a year and a half worth of your bills. You have to have that. The next bucket is the 401k, your qualified money. You need to max that out. That's kind of your income bucket. It's self-intuitive, and you've got to max that. Then when you get beyond that, into the more aggressive things, even though you may not think real estate's aggressive, that's when you can do that stuff.
Yeah, remember, that's one of our litmus tests on if your advisor's looking out for your interest or their interest, or if a buddy is.
That's right.
Because if they tell you not to forego investing in a 401k and buy something else, they don't understand math, or they're not looking out for your business.
I forgot to mention something before I wrap that up. If your 401 you feel isn't performing like it should, or you're bogged down with the choices, or you just don't get it because you don't do it every day for 30 years like Victor and I do, call us. I can't tell you how many people we'll go through their allocations with. We can give you a simple, easy formula that you can follow for the allocation of those funds that could put you, or should put you, on the best possible course to achieve the goals you want. Again, if you want help with that, our number is 972-715-2424.
Yeah, I just actually saw one last week. Normally, we'll get a 401k in, and it's not allocated optimally.
Right.
Not even close. I got one last week. It wasn't bad.
You ever get those with like 15 different mutual funds or 20?
Oh, yeah. Whether you get them like too diversified or too concentrated, there's all kinds of things.
Sure.
Or they're heavily weighted. They have 100% U.S. large cap in there, U.S. small cap, whatever. But you find that a lot. But most of the time, people just don't know. There's nobody to help you. People don't want to help. In other words, a financial advisor can't make money on your 401k, and they bring on some amount of liability.
That's right.
So most of them just stay out of it. We will help you here. If you're a client of ours in another area, we'll help you with the 401k. It's just part of our service.
Yeah, and the reason we do it, obviously, is we'd like to earn your business down the road when you do get to the age that you want to retire or it becomes portable. But more importantly, that's what we do, and it's easy for us to do, and we can help you make those decisions.
What's your next question, guy?
I don't know. Let me put my glasses back on. I took them off. We were on a roll there. All right. Shoot, we're only on number 3. They're going by slow. What are your thoughts on a self-directed IRA?
The last time I got that question was a person making my omelet at a hotel we were staying at.
That's funny.
They go, "Hey, I heard you guys talking finances. You guys are probably financial advisors." And they said,
"Oh, I remember. I was there.
What about this self-directed IRA?" I'm like,
Yeah.
"Okay." And I gave him the thing. I said, "Well, what are you investing in the self-directed
Was it
IRA?"
oil and gas or something?
It was real estate, actually.
Okay.
And I told him, just because you can doesn't mean you should, kind of thing,
Right.
Anytime somebody gives me a self-directed thing, remember, all IRAs are kind of self-directed. You're buying whatever you want in there, right? Nobody's directing it for you typically.
You can put futures in there if you
You
want.
can put anything you want. But it's usually somebody that's trying to because they're talking about The sales guys on private investments, like private REITs, private oil and gas deals, are telling you this is some new thing. Oh my gosh, this is self-directed, not a regular IRA. All IRAs are kind of self-directed. But some trustees will allow you to put whatever you want, the kitchen sink in the dang IRA.
And they're the ones that charge the most.
That's right. So they'll call it, oh no, there's this new thing, it's self-directed. There's no such new thing, okay? But I told them, I said, well, this is dangerous, okay? Let's say you buy a rental property. You have a $100,000 IRA and you buy this rental property with it. You need a new air conditioner. Now, you have to pay with IRA funds. Since I just replaced an air conditioner recently for $12,000, one of them, right? You got to come up with $12,000 out of an IRA.
Can't be non-qualified.
It cannot come out. You cannot pay for one dime of repairs outside of an IRA. Well, that's the maximum IRA contribution you can have is what, $6,000, $6,500. So how are you going to get this $12,000 in there? Well, that will make the entire transaction taxable. All $100,000 will now you owe tax and possible penalties and everything else, because that's the one thing they don't tell you. But if you kept like a small portion, most of it's in the IRA, you can manage that okay. But so many people put the whole thing or large numbers. Don't hesitate to call us if you have any financial questions. We're here to help. 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Today we're answering your financial questions. We've been doing this a long time, 30-something years each. Remember, I'm a numbers guy. I used to be in the military and nuclear chemist. I like numbers. Math never lies. People can lie. People can mislead you. Or they could say, hey, here's all the benefits, and really brush over the negatives, right? But numbers never lie. Now, make sure when you see an illustration from somebody and it starts in like a weird date, I see this all the time. They go, no, look at this managed program. And I go, okay, these dates are from September of 2009 to May of 2017. Why would they put these weird dates? How about January 1 to January 1? Well, they're trying to cherry pick something that makes the illustration look the strongest. Don't pay attention to any one. Now, if it's a 5-year, 10-year, 20-year, average or whatever, that's okay. But it can't be some weird dates. The only weird date I'll allow when I'm looking at illustrations is that's when it started. Maybe it started in the middle, but you better give me years for them, not rolling 10-year periods. If you do rolling 10-year periods, you can make those almost anything you want.
One thing I look at exclusively when I look at examples is the projected rate of return. And I don't like to see a number higher than 6 or 7% because that skews it as well too. So I'm very careful as I look through things to make sure that's a realistic number.
Oh yeah. What's our next question?
All right, our next question is, I've heard advisors recommend delaying Social Security until age 70. I'm not sure that I'll be alive or that Social Security will be there by the time I'm 70. Tell me again why I should wait to 70.
Besides between full retirement age and 70 being at 8% per year, it's simple interest, so it's not as good as 8 compounded, but it's still 8% a year growth in that Social Security payment. There's other things. Remember, also, if you're married, that Social Security payment is for 2 people. Remember, the lowest one is going to drop off if one of you passes away. And so if you can get the highest one higher, it's going to go for both your lives. I've got people making, $400,000, $500,000 a year and start that thing at 66 or something. And I'm like, what? He goes, well, I'm going to get my money back out. Truth is, you didn't put that much money in it. If you look at your Social Security statement and tell you how much I've maxed it out for decades, and I've put in maybe a couple $100,000, and I'm going to get $4,000 a month. Trust me, you're getting a good deal on the thing, right?
Right.
But it's for 2 lives. So if you're still working, just delay the Social Security, because remember, even if you passed away at 72, you got just bad genes. Well, your wife might have good genes, right? And you're going to stick her with a $2,000 payment or a $4,000 payment. So you have to look beyond yourself, number one. I get the whole bird in the hand kind of mentality. Hey, at least I get a little bit out now, because I've had them take it at 62 and forget that they'll penalize you if you're still working and all that. I think you can make like, what, 14 grand a year, something
Right.
low. So you got to be careful, because that payment, if you run the numbers, which we do, we offer a free Social Security optimization program that'll show you the long-term effects for both of you, not just one person. Because what people will do is always do simple math in their head. Okay, if I take it to 62, oh my gosh, those missed payments, waiting till 70, I'll be 79 years old. Nobody's lived in my family past 79. But when you're both alive, when you have a 65-year-old couple, there's a good chance one of you gets to 92. Married people live longer.
And
I don't know why, but I figured it'd be less. But no, they live longer.
I hear you on that sometimes. And if you're thinking, no, I put a lot of money into it, just do this simple math. You're paying 7.5% of your salary. Your employer's paying 7.5%. Let's just use $100,000. You pay for a smidge above that, but let's just say it's $100,000 that you make. That's $15,000 a year. In 10 years, it's $150,000. And if you wait to 70 and you're getting, what, $35,000 a year, $40,000 a year in income off of that, it doesn't take long to get your money back. So you're not putting in really as much as you think you are.
Back in the 80s, 90s, you were only putting up to $40,000 of your income. So it was only 7.5%. It was 6% because Medicare is the other piece.
Right.
But it was only up to like 40 grand in income. Then it went up to 50, 60, 70, 80. So I'm telling you, you didn't put in as much, because I've maxed it out for decades.
Right.
And you will not put in as much. So if you thought that you could have invested that money, maybe you could have. I don't know, because it would have grown, obviously.
Sure. Oh, no,
right?
I get that.
But just from the raw numbers of you putting in.
If you didn't touch it.
That's right. And they always tell me, is it going to last? There's no way it's going to be there. Well, look at Obamacare. Does anybody really think Obamacare was the greatest thing in the world? I like the pre-existing conditions, stuff like that.
Sure.
But anybody think really that it basically was trying to insure this 5% of people that are not insured, or 10% of people? And the unintended consequence is it raised the premiums on everybody else, the 95% that already had insurance.
And I may be wrong, but you never hear about welfare not being there for the people that need it. I'd sure like to see them try to take Social Security away from us that have contributed to it.
Look at them trying to take Obamacare that's not that popular. They're having a real problem getting rid of that, right?
Absolutely.
You're not going to take care of social
entitlements.
Politicians will change parties. They'll change everything to stay in office, to stay in power.
Yeah, absolutely.
If you think they're going after the largest block, because everybody gets Social Security, right?
That's it.
Everybody's affected by it. That's why they always say, let's tax those 250. They only 1% of the population makes $250,000 a year. They can't vote them in or out of anything.
That's right.
So let's attack them all the time. They're bad. Let's take more money out of them. They know that they got. But if you attack Social Security and you make too high adjustments on it, you're out of office. Well, that's our show, folks. I want to thank everybody for listening to the Common Sense Investing Show today. If you have any financial questions or you need to talk to us at any time, 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.